Good morning, everyone. My name is Carrie Ramsey, and I am the project manager for the Weekend Project at Queen's University. Some of you I've met before, and some of you are new to me. So we're excited today to be engaging with Michelle and Laura from RBC. And first of all, thank you so much for joining us on what I know is a beautiful day in June. And there are a million things you could be doing in your garden, at the beach, or other spots. But you have decided to invest this hour in yourself and in your business, talking about cash flow. And if there's one thing I know about women entrepreneurs, we tend to shy away from talking about financials if we possibly can, especially the creatives among us. But I think it's awesome that you're going to take this time. We've got two amazing women who are joining us to share their experiences. And if you'd like to just take a moment to find your chat button, which for me at least is in the bottom middle of my screen, and just let us know where you're connecting from today. Let us know the name of your business. We love to get to know who attends our workshops, of course. And part of the purpose of having the weekend community is to also allow women entrepreneurs to connect to each other. So we'd love if you'd use the chat to do that. And while you're taking a moment to let us know where you're connecting from, I'll mention that I am connecting from Belleville, Ontario. And Belleville is also known as the Dish with One Spoon, which is an Indigenous territory. It's a hunting, fishing, and gathering territory that has been here for generations. And so we are certainly privileged and honored to live, work, and play here on the banks of the Moya River, which is just spectacular in the summer. I mean, it's lovely in the winter, but during these summer days, just meandering down that river trail is an absolute pleasure. And so I do want to acknowledge that is where I'm connecting from today. So thanks so much to everyone for letting us know where you're connecting from. Again, if you're just joining us, you can do that in the chat button. And do take a moment from time to time to check the chat out. There may be questions posted there. I'll be facilitating today. The speakers have asked if you'd like to hold your questions till a little bit later, that's fine. If you have a burning question and you want to put it in the chat so we don't lose it, by all means do that, and I'll be taking notes of that. So without further ado, I'm going to present to you Michelle and Laura, and I'll just give you a heads up. Michelle is connecting from a slightly more rural location today. So if she fades in and out, Laura's going to be there to jump in. But both of these ladies are so skilled in their field, and we're looking forward to hearing from you today. So if everyone wants to put themselves on mute, just so that I haven't done that for you guys today, just to let you know, that will allow everyone just to focus in on the speakers. And take it away, ladies. It's all you.
Perfect. Thanks so much, Carrie. My name is Michelle Bryant. I'm a commercial account manager in the Kingston area. As Carrie said, I'm connecting from north of the 401 in Odessa, which is just about 10 minutes outside of Kingston. And with me is Laura. So go ahead, Laura, you can introduce yourself.
Thanks, Michelle. So my name is Laura Brown. I am in Kingston. I am a business account manager with RBC. So I work pretty closely with the commercial team and Michelle. And we're excited to chat with you today a little bit about cash flow, and I really hope that you get one or two good learnings out of it.
Perfect. So we'll go ahead to the next slide, Laura.
Okay. There we go.
Okay. So what we're going to cover today, we're going to cover the importance of cash flow, working capital, and the cash conversion cycle. We're going to look at working capital management strategies, managing cash flow in a time of crisis, and we'll go through some interactive tools. So to start off, I mean, the importance of cash flow has never really been in question. Positive cash flow is essential to the current and future success of your business. So why does a business need cash? It's for everything. It's the lifeblood of the business. You need it to finance operating expenses. You need it to pay employees, invest in property, plant, and equipment, pay taxes, reward owners. Next slide, Laura. And A lot of businesses fail because of cash-related reasons. Some of these reasons are poor cash management skills, poor understanding of the cash flow cycle, and a lack of understanding of profit versus cash. And we're going to touch on each one of these today. I suppose we can add a fourth one, which is a global pandemic, but we'll touch on that too a little bit later on. Okay. So it's useful to know the difference between the cash flowing into your business and net profit. It's often a common misunderstanding when it's time to pay tax. You've worked hard all year, placed everything back into the business, and you haven't drawn a cent. So as far as you're concerned, you've earned zero. But the accountant says the business has made a profit and now you have to pay tax. Another common problem is where a business is profitable, but it runs out of cash and can no longer pay its bills. So how can it be? So if we look at the definition of cash flow, it's the cash that comes in and out of your business every day. It's the money in, it's the money out. So for example, let's say you have annual sales of $100,000, you spend $60,000 in expenses, and you decide to buy a $40,000 piece of machinery. So that leaves you with the $0 in the bank. That's cash flow. Next slide. The profit, on the other hand, is what the CRA will tax you on from your end-of-year accounts of your business operations. It's calculated by adding up all the revenue, subtracting all expenses, leaving a profit balance. So in our last example, the $40,000 piece of equipment, it's going to last more than 1 year, so you need to depreciate that asset over time, and you can't deduct the whole lot of it at once. So if, for example, we give a depreciation rate of 10%, and that'll cost you $4,000 a year. So looking at that same example, you have the $100,000 in sales, less expenses of $60,000, less the $4,000 depreciation. That leaves you with a profit of $36,000. So you have to pay taxes on that $36,000, but you have $0 in the bank. So that's the difference between the cash flow and the profit. So by no means should you ignore your profit situation or shift your focus entirely to cash flow. The trick is to balance it out. So you need to plan to make your purchase of new assets at the start of your financial year, not at the end. Only spend cash on capital items if you have a cash surplus. Unless it's a great bargain and you have the cash, don't buy large amounts of inventory at the end of the year. Try and pay for items over time to keep your cash intact. Ask suppliers if you can buy inventory on consignment. Lease, don't buy assets if they're not used all the time. Adopt virtual warehousing model or integrate your inventory needs online so you only buy what you need when you need it. And be careful not to draw too much from the business during the year. And remember to plan the dates when your business taxes are due. A large tax bill is difficult to pay if you haven't planned for it in advance, especially if it arrives when your cash reserves are low. So be sure to talk to your accountant about any tax planning strategies. So next slide. So as we've stated, the cash drives the operations. Cash flow begins when the first dollar is spent, and it ends when the cash is collected from the customer. This illustration of the cash conversion cycle demonstrates how cash flows in and out of the company with activities such as investing, purchasing, selling, and collecting. So if we look at the light blue circle in the probably 2 o'clock range of that diagram, cash is used to finance the operations of the company, to purchase equipment, run any manufacturing processes, and for all other support operations. Material, goods, supplies, and equipment are ordered from vendors, and those vendors will either be paid on cash purchase, or more likely, they will extend credit to the company and the company will pay later. Where the company has made purchases on credit, it creates an accounts payable, and when the company pays that account, it uses cash to do so. So when products and services are created, cash is being used in this part of the cycle as well. Employees are part of this process, and they are being paid within the cash cycle. So too are the use of resources to carry on operational activities. These include utilities, repairs, maintenance, along with selling, marketing, and administrative expenses. When products are sold, sales are generated, and we're closer to reaching the end of the cash conversion cycle. When sales are on a cash basis, the conversion cycle has completed. However, most companies extend credit to their customers, allowing them to pay later, and thus creating an account receivable. When the customer pays its account receivable, cash is collected, and we reach the end of the cash conversion cycle where we're back at cash and the process starts over. So the company can either put the cash back into the business, or if there's surplus cash, it can make investments that are separate from the operating cycle. So the end goal of this entire process is to unlock the value trapped in the cash conversion cycle. And it's that's the most important when conducting your cash flow analysis. So let's go to the next slide. For the purpose of understanding cash flows and what the business needs in order to sustain its operations, we're going to examine operating working capital. This is the money that is both used and created by the business in the ordinary course of operations. It consists of 3 accounts. There's inventory, and for manufacturer, there's 3 types. There's the raw materials, the work in progress, and finished goods. For retailers and wholesalers and distributors, inventory relates only to finished goods. Inventory turnover is a common measure used to understand how inventory is affecting the cash flow cycle. It refers to the number of times that a company sells and restocks its goods. And it's one of the primary sources of cash, revenue generation, and subsequent earnings. Too much inventory being held could lead to obsolete items that are difficult or impossible to sell. So this makes inventory a use of cash that the company may not be able to recover. The next one is accounts receivable, and that relates to the purchases made by a customer on credit. The longer it takes to collect the receivables from customers, the more likely that bad debts or write-offs for non-payment will occur. So from a cash flow perspective, the longer it takes to collect payments, the less cash is available to pay your business's debts. And the third one is accounts payable, and that relates to the purchases made by the company on credit. When the company takes longer to pay their suppliers, there's more cash on hand now because the creditors are repaid later. However, some companies will tend to pay their suppliers earlier than set repayment terms, sometimes in order to take advantage of early payment price discounts. So next one, Laura. So this is another way to look at the cash conversion cycle that will help in your analysis of cash flows. So we see the activities we just discussed along the thin line with the yellow arrows, and these activities relate to the 3 accounts that make up the operating working capital cycle. So the accounts payable are in blue, the inventory is in teal, and the accounts receivable is in, I don't know, dark blue, purple, or indigo. Not quite sure what that color is. The cash conversion cycle, also called the working capital funding gap, it relates to the amount of money you will need to have on hand for that period of time between when the cash leaves the company and when it comes back in. So it's calculated by adding inventory days to the accounts receivable days and deducting the accounts payable days. So on the next slide, I have an example of that. So the first example, let's say your inventory sticks around, you can turn it over in 75 days. You're able to collect your receivables in 30 days, and you pay your suppliers in 90 days. Now, I have to note, these numbers are a little bit wonky. I just use them for illustration purposes, just to get the point across. So if we add up the inventory days and the receivable days, so that's the 75 and 30, you deduct the 90, that leaves you with 15 days. So this means the company needs to spend the cash 15 days before it's collected. So there's a funding gap here. You don't have the cash on hand to make your payments. In the second example, it takes 40 days to turn the inventory over. You collect in 30 days and you make payments in 90 days. So the 40 plus the 30, you deduct the 90, that leaves you with a negative 20 days. So this means the company is able to keep the cash in its account for 20 days before it needs to spend it. So there's no funding gap. You actually have really good cash flow at this point. So when there is a funding gap, you should talk to your banker to find out if there's any solutions that they have that can help you with keeping the cash flow during this time of the funding gap. And there we go. So there are several ways to shorten the cash conversion cycle or the funding gap. Pick your term that you like the best. If we look at these examples based on the working capital accounts, so we'll start with the inventory. So you want to lessen the number of days it takes for the inventory to turn over. You want to consider increasing the speed and efficiency of inventory purchasing and conversion. So how could this be achieved? One way would be to improve production processes so that the raw material and work in progress aren't sitting idle for long periods of time. Another way would be to use a method of purchasing called just-in-time inventory. So under this method, you'd purchase inventory when you need it versus stockpiling it and waiting for the customer to order. Not all businesses can support that model though. So if we look at accounts receivable, next slide. There we go. If we look at the accounts receivable, you want to lessen the number of days it takes for your customers to pay you. So one way is to ensure customers are billed immediately upon sale. Sometimes we see companies will wait until the end of the week or later, or they'll just pick the 20th of every month until it produces the invoice. And this is an unnecessary delay to the cycle. If the purchase happens on the 1st and you wait 20 days to send the invoice, then it takes that much longer for the payment to come in. Another way would be to offer early payment discounts. However, incentives for customers to pay early may negatively impact your cash flow, and therefore a cost-benefit analysis should be done before offering this step. Where a customer purchases large amounts, you could request upfront payments or deposits. You could also shorten your credit terms to customers to 30 days or less. However, this strategy needs to consider the relationship of the customer and ensure it doesn't put it at risk. And finally, follow-up is critical. You should ensure timely payments through engagement and active follow-up with your customers. So the last one is the accounts payable. And when you think about accounts payable, you want to carefully time the payments to suppliers without straining the relationships. This means lengthening the amount of time accounts payable remain outstanding. So another related method is to negotiate more favorable payment terms with suppliers. For example, maybe extending your payments from 30 days to perhaps 45 days. Another alternative would be to not have the payment terms extended from suppliers, but rather use a credit card to pay them. So by paying with a credit card, you can extend the cash flow by up to an additional 51 days. So next one. So to improve operational effectiveness and enhance shareholder returns, because really that's why a lot of us are in business, a company must successfully streamline its cash conversion cycle and optimize its liquidity position through effective working capital management strategies. And there's two that we're going to look at. So the first one that a company can implement is to streamline its cash conversion cycle. So first, you can eliminate the processing errors by automating your collection and payables processes. You can also use optimal payment types. These would include things like offering merchant services or debit credit card payments to customers, using electronic funds transfers, or even using credit cards to pay your vendors if the funding gap is short enough to do so. The company could also look at centralizing access to customer and vendor information and the related outstanding balances to provide more information on the timing of payments and receipts. And finally, by setting policies for maximum credit limits and the process for collecting on outstanding accounts, the company can build in more efficiency into the cash conversion cycle. So the other key objective is to optimize the liquidity position of the company. So this means using effective payment and collection mechanisms. So again, going to electronic solutions, you gain more control of your cash flows. You'll also have more confidence in the decisions that you make, like investing, let's say. The company can also look at ways to streamline its other existing banking structure. So for example, a company that has operations in multiple divisions, each with its own bank account, there are different ways this could be structured. We could allow all the accounts to remain individual and sweep the balances all into one operating account, or they can continue to operate separately and treat it as though all the balances are pooled together. So when a company does have surplus cash, it should quickly invest the cash into short-term products that will earn it some investment income. So the next one, Laura. There we go. As we've seen, and the ability to manage cash flow is fundamental to your company's health. And when you add in a global crisis and the fallout that's deeply affected businesses around the world, your command of working capital becomes critical and considerably more difficult. Without question, these times are exceedingly tough right now, and many businesses will struggle to weather the storm the world is facing. But having control over your cash and the visibility of your future position can help you emerge from the crisis and move forward. Anytime your business faces a crisis, it's important to assess the impact of the situation so you know where you stand. Consider 4 areas of impact to focus on right now and to continue evaluating as we see businesses reopen. So the first area is the short and long-term cash position. In simple terms, your future cash position is an assessment of what you have today plus what is expected to come in less what is expected to go out. The best way is to get a sense of the future cash is to run a sensitivity analysis, including a number of different scenarios, the what ifs, if you will. And Laura will cover this a little bit later on. And as you plan, you want to make your assumptions as to the number of months your business will feel the impact of the crisis and the effect it will have on sales. If you're losing money, you'll want to calculate your burn rate now so you know how long it will take to go through your cash. The second area you want to consider is your payables. While it might feel like much of the world has ground to a halt, your business still has a responsibility to pay your suppliers, staff, rent, insurance, equipment, auto leases, and the list goes on, I'm sure. There are two keys to maintaining a healthy cash position as possible, and that's to organize your payments and prioritize the ones that are absolutely necessary to continue paying. Third area you want to look at is your receivables. New sales may be harder to come by, and existing customers may be slower to pay. While you may already have a clear view of what is expected to come in, at this time it's important to look at it with a lens of the financial health of your clients. Will they be able to pay? If they are struggling, can you offer deferrals to ease the crunch for them? And the fourth area you want to examine is your supply chain. And you want to determine the impact there may be to your ability to produce or purchase product. Will the suppliers be able to deliver necessary items to your manufacturers? Will the manufacturers be able to maintain the productivity levels required to deliver the goods to you? So once you've assessed the impact of the pandemic on your business and know where you stand, you want to consider some other strategies to help control the flow of funds in and out of your company. So next slide, Laura. So first you want to regularly monitor and forecast your cash flow. The daily monitoring of cash balances and reconciliation with your accounting or your ERP software. You want to know the up-to-minute working balance. It's a good idea to implement a cash flow forecasting process on a 13-week cycle to help drive short-term decisions as they relate to your payables, receivables, and inventory. Usually we would say forecast longer, but in this time, keep it shorter. The second strategy you can implement would be to offer digital payments. We've already mentioned this. I've already mentioned this before. These options can help minimize fraud and reconcile your accounts faster and easier. Third thing you can do is extend your payables. Your top priority is to take care of your people and your community at a time like this. So it's worth exploring options that can help you avoid layoffs. Consider temporary reductions in hours, asking employees to defer or reduce pay, or accept equity in lieu of cash. If applicable, you might want to ask the business owners, which mostly you lovely ladies, to set an example by reducing or eliminating their wages first. When you can pay your vendors, suppliers, or taxes by electronic means, you control the cash that comes out of your business, thereby requiring you to maintain less cash in your accounts at all times. As you evaluate the payments you need to make, you need to determine which suppliers are mission critical to the success of your business and reach out to them first. Discuss the opportunity for partial payments or asking for a discount if you can pay on time. Explore options for deferred payments and see if you can work out payment plans that work for everyone. Keep in mind that the relationships you have with your suppliers are extremely important right now, and the trust you have built up with them will go a long way. Approaching discussions with empathy and understanding will help more businesses get through these times together. Then you can proactively manage your receivables. As you evaluate the money that's due to come in, it's important to proactively engage your customers to find out how they're doing and how likely they are to be able to pay on time. Be sure to prioritize customers with large balances and work together to build a payment plan that's achievable for them. Consider offering discounts for shorter-term payments, partial payments, or real-time payments such as credit cards or Interac e-transfers. And remember, regularly monitoring outstanding accounts will help eliminate surprises. It'll keep the cash coming in faster and take action on balances that tend to slide past their due dates. The fifth thing you can do is get creative with your inventory. And we've seen this already. Many industries are experiencing supply chain disruption these days, so it's more vital than ever to know what you have in stock. Increasing the frequency of your inventory counts could help you understand what materials are running low so you can quickly reorder or maybe order more than usual. And at the same time, you want to get an understanding of what's moving and what's not. Customers' needs have changed dramatically over time. So even if you're running low in one area, if the demand isn't there, it's worth focusing on materials that are currently more sought after. Then get creative. There have been stories of breweries pivoting to create hand sanitizer and clothing companies making masks and other PPE gear. So consider how you may be able to expand your business in ways that might never have considered before. And one of the last things you can do is, of course, look at government assistance. Recognizing that businesses like yours are the lifeblood of the country, the government has developed a number of initiatives designed to help owners keep the lights on. So we have the Canada Emergency Business Account, which is CEBA. You can apply for that through your local through your main financial institution. There's the Canada Emergency Wage Subsidy, which you can apply through the government's website. The Business Credit Availability Program, that's offered through the banks in partnership with BDC or EDC. And of course, there's other initiatives from your local innovation centers, community development corporations, economic development corporations. So there's many different places you can go to look for assistance. So that's the theory part on that I have to present. I'm going to pass it over to Laura, who's going to go through the interactive tool.
Thanks, Michelle. Michelle, actually, if it's okay with you, because you went through all the heavy stuff, and ladies, I'm going to go through 3 interactive tools, which I think are super helpful. I've been using them quite frequently with my clients now, assessing how they're doing pre-post and what their outlook is for the future, given everything we've all been through. And Michelle and I are very empathetic to all our business owners out there. It's been a crazy couple months. So, you know, we do appreciate you guys taking the time to be with us today. Michelle, does it make more sense to maybe, if anybody has questions on the theory before I jump into the 3 tools? What do you think on that?
Sure. Yeah, that could work.
Does anybody have questions? Because I know she went through a lot of stuff there. And if you have any questions, maybe now is a better time to ask, so that when I'm going through the tools, it might make a bit more sense.
And we know some of you have questions, so do not be shy. We are recording this session, as I've placed in the chat. So if some of this is flying past you really fast, definitely email me and request to get a copy of today's recording. Any questions though? Anyone want to raise their hand? Just, you know, shout out. You should be off mute. Going once. Any acronyms that were mentioned that you weren't sure what they stood for? All right, think about it, because we'll come back to make sure that you have an opportunity to ask questions shortly. So jot them down, do not be shy. You are not the stupidest person in the room. This is what I feel like half the time in these workshops. So please trust me. If you have the question, other people have the question. So ask it a little bit later if you're shy now, or drop it in the chat. Laura, you can probably continue. Oh, go ahead.
There was a lot to unpack in that.
Yeah.
Yes. And she went through that pretty quickly. Like, I know we have a fixed time. So if you had any questions, please don't hesitate to even email us afterwards. So I'll carry on. I'm going to go over 3 interactive tools, which I'm also going to share with Carrie afterwards. That Carrie, if you don't mind just sending them on to the group for people to use. So the first tool I'm going to look up is the Startup Cost Calculator. And I do realize that we have business owners at all stages. You might be a mature business owner, and part of this first calculator might not be super applicable to you, but I do think it's still good to go over, specifically to get another, the working capital piece. So when I talk about startup costs in this first calculator, it's going to look at your setup costs. So these are typically one-time items, you know, purchasing your equipment, office supplies, renovating your space, if that's applicable, marketing, all that sort of stuff to get your business off the ground and running. And then the second piece, which I think is sometimes overlooked a little bit, is the working capital piece. Specifically when I meet with business owners that are just starting out and they're looking perhaps for some financing for the initial setup costs. Working capital is the money you need month after month, regardless if you have any client or customer come through your door. So it's what the business needs to keep the lights on, to keep in operation. So this would be your payroll, perhaps rent, utilities, etc. And working capital, I think, at least we typically as bankers, we like to see that you've accounted for 3 months worth of that. And given we've just gone through a whole economic crazy period, I think that in this calculator, the startup cost calculator, it's definitely worthwhile to just get a new pulse check on Has your working capital needs changed at all? Perhaps you've had to lay off some staff, so that's adjusted. But it's definitely a good time to relook at that and make sure that you have what's needed to get through X amount of months until, you know, we get back to some sort of normal. So startup costs, where to get the money, the calculator, when you go through it, it does talk a little bit about this. So obviously you can inject your own savings into the business if available. Perhaps you borrow from friends and family, or perhaps you approach the bank for either loans for this setup costs or the working capital. Outside investors, crowdfunding, and then, as Michelle touched a little bit about, is government grants and subsidies. Specifically, if you look through Innovate Canada's website, I'm always impressed to see how much funding's out there for business owners in all different types of industries. So it's something absolutely to revisit at any stage of your business's life cycle. So here it goes, and again, a little checklist on where can you get the money. I just want to point directly to number 3. So speed up your cash cycle. In times like this, now it's probably a great time to revisit it. And so here it's looking at how can you get paid quicker? How can you reduce that funding gap that Michelle was talking about? So whether that's you negotiate better terms with your suppliers so you can hang on to it a little bit better, maybe you, the way you get paid changes. So you take deposits ahead of time, or you go more towards a credit debit system so you get access to the funds quicker, whatever that may be in your business. I think that's the key when we're looking and reevaluating this tool, especially given we just went through a global pandemic. This is just a snapshot of the calculator if you were to go through it. So the initial cost piece, again, might not be applicable to all business owners on the call today. But what I wanted to highlight was the working capital calculations. It's a great tool to go through, and I've been going through it with a number of my own clients right now to make sure we understand what is it that the business needs to keep the lights on and keep going through this uncertain time, especially when your income could be drastically different than you projected at the beginning of this year. The nice part of this working capital calculation is any of the tools also that I'm about to show you, all 3 are very customizable for your own business. So I highly recommend you download it, you manipulate it so it fits your business a little bit better. And these are great tools to check in on and run the numbers again, just so you make sure that working capital, in particular now, that you have the working capital needed and that you're reevaluating it so you're matching it. And if there is any changes, how can we accommodate them? How can the business accommodate them? The second one I'm going to go through, and this is probably the biggest meats and bones, is the cash flow forecast tool. And here I just want to highlight that whenever you started your business, I'm sure you went through some sort of building a business plan. So where you described, this is why I'm going to be successful, this is my competitive advantage for the product and service I'm going to be offering. And then you would have likely gone through financial projections or a cash flow tool to say, here's proof that what my words are saying is actually going to be financially feasible. And I think the biggest, the most successful business owners, they are using this business plan and these financial forecast tools on maybe an annual, quarterly basis, whatever it is. And they're constantly adjusting and modifying it. Why? Because it holds the business owner accountable, but also because it's a great way to check your progress. And it's a great way to check in and say, okay, you know, this change or the way I implemented maybe this strategy wasn't as effective as I thought. Let's change it or tweak it so that when you get to the end of the year, you are more likely to achieve that goal you set for yourself and the business. I did add the initial SWOT analysis here too, because I think given we've gone through a crazy time and COVID-19's changed many businesses in different ways, it affects everybody a little bit differently. It's a good opportunity to make sure that, you know, maybe your strength before this pandemic was your staff. And when your staff got in front of customers, you know, they could win business hands down. And maybe that's changed because you're now, you're providing your product or service through online channels. And so that's all changed, and you might have to modify your business plan. And as a result, your cash flow forecast on, to make sure that you still have that advantage in the market. I do want to so when you go through the cash flow tool, it does talk about the startup costs. This is not something you have to fill out if you are a mature business. You can skip over that particular part. But then it will look at 6 months of your money in. What are your expenses? What do you predict to have coming in? And I'll have clients that'll use that, the money in. They'll look at the 6 months from last fiscal year and they'll plug that in. And then the money out, you know, this is your working capital costs. This is your expected expenses. And you have the options in this tool, you know, for your particular business. There might not be a lot of seasonality, or it might not change very much month to month. So you can structure it that way. But perhaps you're a retailer or maybe a restaurant, and you know, every month is a little different. For instance, I know a lot of restaurants, January and February, typically a lot quieter because people have, and November, December are busier because of holidays, etc. So you can use in this tool, you can accommodate for that month to month changes. And then we'll focus on number 4 here, which is what Michelle was talking about on the what if scenario, which I think all business owners are in that position in some capacity. Here is just a quick snapshot of one of the cash flow tools available. And you can take this right from the RBC website. I strongly encourage you to use and change and manipulate it to fit your business better. It's a very strong tool. The one thing I just wanted to show here is I think it's super impactful because it breaks it down month to month. So it really makes, it's kind of a good check-in to look at what's happening month to month, especially now when, you know, I'm sure March and April were drastically different months than you predicted at the beginning of this year. And so it gives you a good opportunity to look at the very bottom of the screen. It will talk about your opening bank balance versus closing bank balance. So you've likely had some sort of fixed costs that are still coming out, but perhaps revenue has drastically changed. So it gives you a good snapshot on where you're trending throughout the year as well. So this is a great tool, highly recommend. And you can change and customize any of these direct costs, etc., to fit your business better. So this is the point 4 I was just briefly mentioned. So this is just a snapshot of the tool. So I actually use this for a particular client. Cash flow, because, or the startup cash portion here, this business owner was, for instance, a mature client. So the startup cash was not necessarily specific, so I left that out, which might be applicable for a lot of you. It's where the cash in and cash out really made a difference. So for this particular client, their month-to-month expenses were pretty fixed. They don't have a lot of seasonality month to month. But here's where they were able to play. So this client had no, you know, revenue dropped substantially from March 17th to the end of April, and they got to play around with it. So in this snapshot, they said, okay, if my expected revenue from here on out is only going to be 50%, but my cash out is going to stay the same, what does that do to my bank balance or your surplus and deficit at the end of each month? And I mean, I think the end scenario here is you're looking, oh great, it's a surplus. But for this particular client, that's a big impact because they do a lot of their inventory purchases on a semi-annual basis. So if you're coming up to the end of the month, typically they use their surplus to fund that. And now they're looking at that surplus has decreased to compare to what they had before. So they're looking at, well, how am I going to be able to purchase that big inventory, you know, on month 7? And so it's planning ahead of time. How are we going to accommodate that, whether it's with bank support or they're looking at government grants, subsidies, etc. So how do they plan for that? So this is your what if. You're, you know, hoping for the best, planning for the worst in this kind of tool. It's a really good opportunity too to see, you're busy business owners, you see the day-to-day hustle and bustle all the time. So sometimes what you might think is happening or translating in the numbers doesn't necessarily. So it's a good opportunity to take back and look at this snapshot for your planning. So here's just a link to that tool. The cash flow forecast, I can't emphasize enough. It's a great opportunity to play around. I know, I'm sure a lot of businesses, and I'm super impressed with so many business owners, how they've been able to adapt and change to this, I hate to say new normal, but new normal that COVID has impacted us. So it's a good way to plan and see, if you're able to make changes, maybe go to a more online basis, etc. How's that work? Estimating your expenses, predicting that money in, money out. What's it look like now as it did maybe compared to last year, or how you were anticipating this year to go? And it really answers the what if. So will you be able to weather the storm with your working capital? Is there going to be a financing need, etc.? And if there is a deficit, how do you adjust? How do we adjust now so that we're in a better position when we get to that point? So the next piece I'm going to talk about is mostly the profit side of things. So growing your business. And the reason I wanted to touch on this is there's, again, business owners, I'm so impressed with how agile you've all been in being able to adapt and find new revenue streams and etc. With how, depending on how your business has been affected by this pandemic. So there's 5 key ways of looking for new growth opportunities or bringing in new revenue streams, maybe adjusting for the cash flow forecast. And so the first would obviously be get more from your existing client base. And I've highlighted that because it's typically the easiest and most cost-effective way to grow your business. I'll talk a little bit more about that in a second. The second option would be maybe find new clients, develop a new product or service, diversify what you do, and enhance the operation or become more efficient. So 4 and 5 can look vastly different depending on what kind of business you're in. But an example of becoming more efficient would be, I have one client who has opted to go for change suppliers because they offer better terms, and the cost will help their gross margin at the end of the year. So it's just a way that they can keep a little bit more profit in their pocket. Diversify operations, there could be so many examples of this, but for instance, maybe you change your business model a little bit. Maybe you've always been a retailer, but now you look at changing and also becoming a bit of a manufacturer, so you can do both sides of it. Again, not applicable in all businesses, but there's a lot of creative ways to look at that. So growing your business is definitely probably the easiest and definitely the most cost-effective way to get more revenue. And the reason we say this is the rule of thumb is 20% of your client base likely makes up 80% or more of your revenue base. And that's a pretty actually standard 80-20 rule when you look at most industries, which surprised me as well. So here we want to look at who is your most profitable client, and where's other areas that you can increase cross-selling opportunities, or perhaps upsell additional products and services for them. A great way is looking at how do those current customers, how do they buy from you? What's their, what are their needs now? How do you think it's going to change in the future, and predict those and get ahead of it? Offer new convenient ways to buy. Perhaps that's curbside pickup now, perhaps that's going to an online platform. How are you going to communicate with those particular clients? Maybe that's developing an email base and being able to send promotions to them. And number 6, building a loyalty program to increase their frequency of purchasing. I attended a really awesome conference last year that talked all about the loyalty program, and it shocked me. So they did a study in all businesses, all whole sorts of every industry in Canada and the States. And they said businesses that had some sort of loyalty program, 66% of those people that purchased anything from them would then come back and be a reoccurring customer. And 66% of them said it was because they had some sort of loyalty program, which is amazing. But the conversion rate of them using that loyalty program is actually only 31%. So it actually wasn't costing business owners all that much to even offer a loyalty program. So example of that is maybe the McDonald's, you buy 6 or 7 coffees and you get the next one free. I know for myself, my hairdresser offers a stamp card, so I think it's your 10th haircut's free. I never remember the card. I go there because of the relationship with my hairdresser. But I think it's just impactful to say if you can provide any type of loyalty program, maybe the first time they shop with you, they get 10% off, and that could be only a one-time offering. But the chances that they'll come back in your door and do more business is 66% higher. So just something I wanted to highlight there. It's pretty incredible. Growing your business, there's 7 steps. This is a really interesting flow chart. I'm not going to go through it in a lot of detail because I will be sending out the links for you guys to play around with. And it will obviously impact everybody's business very differently. So that's just one option. What I wanted to talk about here was the profit calculator. And I think this is a nice thing to also play around with, given you might be now targeting a different client, or you're probably looking at how do I get just a little bit more revenue out of my existing client base. So what's nice here is you can look at your current performance, and that might have been how you're doing up till March, COVID hit, or it could be, you know, year to year comparison that you use. So the number of clients you have, what's your conversion rate if you know it. If not, it's a good opportunity to play around with it. And then it talks about, you know, if every customer that comes through my door buys 2 things or uses 2 services currently, what happens to my net profit when I, you know, increase that by 2.2? It's actually pretty impressive seeing the resulting net profit and how that can change with just a slight tweak. I mean, you're not looking for a whole lot more here. If you're only improving your conversion rate of clients in your door by 1%, or if you're only upselling, you know, 0.2, that doesn't, when you break it down in terms of that, doesn't seem like a huge challenge. But what it can do at the end of the day is pretty significant. And this, I find a lot of clients will find really impactful, even when they share it with their staff. If you have staff that help with sales or providing services, etc. So here's the link to that profit calculator. Obviously, the way to increase profit, you've got 5 options. So increase the number of your potential customers, which could be expensive. I understand if you're suddenly advertising to a whole new target market, you know, that could be a challenge. Maybe not, but it could be. Increasing the number of conversions into customers. So obviously, if you've got somebody coming through your door giving you a call, it's easier to probably convert them to a sale than somebody who's not even looking the business up. Increasing the number of transactions per customer, and increasing the average sales value of the transactions. So I'm not telling everybody to suddenly jack up their rates, but with that calculator, you're certainly able to play around with that net profit margin and see what it would do. Yeah, so those are thoughts for profit. Putting it all together, so Carrie, this is an awesome link because it shows all 3 of these calculators together, so you can kind of take which parts you find most applicable and use them that way. That concludes my interactive tools. I highly recommend you play around with those tools. And please, if you have any questions, stop me. I don't know, Carrie, if we've had any come in on the chat. I haven't been monitoring it.
No, I haven't seen any, but let's pause just for a moment. Are there any questions about the tools that Laura has mentioned, or anything that you want to insert at this point? This is for you. Anything that is a concern or a new question that's come up at all? So there's a question, Laura, are these Excel tools, are they in an Excel format? Thanks, Janice.
Yeah, that's a good question. So they are Excel based. When you download them from the RBC website, they'll look a little different, but you are able to copy and paste them into Excel and then customize from there. I've had clients do that, so yes.
Good question. Any other thoughts? Do you see the one there, Laura? Can you explain the loyalty program benefits again?
Yeah, so it was just a conference I had attended. So of businesses that offered some sort of loyalty program, or they even said incentive to new customers. So that could be, you know, if this is your very first purchase with us, we'll offer 10% off your first purchase, for instance. So of the businesses that offered some sort of loyalty or initial incentive to clients, those particular clients were 66% more likely to visit and purchase another item from the business versus those businesses that didn't offer any type of loyalty or incentive program. A lot of businesses are worried about offering loyalty or these types of incentive programs because they think it can be more costly for them to implement and to offer. But what they said of those 66% of clients that were coming back because you had the loyalty program, only 31% actually utilized or got benefit from the loyalty program. So it doesn't mean offering it could be a great way to attract more clients, gain returning customer base, but it doesn't mean that all of them are going to utilize it, and it's not as costly as business owners often initially think it would be to offer these type of programs.
Right.
Is that clear? Does that help? Does that answer your question?
I'll watch the chat for it. There's another question from Rita about affiliate marketing, and I'm not sure how familiar you are with that in terms of pricing, but Rita's asking if you have any advice for pricing for affiliate marketers.
Could you just clarify, Rita, what you mean by affiliate marketers? I don't know, Michelle, if you've got more, you mean like social media or social influencers? Is that what you mean?
Yeah, I'm going to assume it's online selling on behalf of, for instance, like a software as a service. So let's say someone is selling ConvertKit maybe, and they're getting a cut for everyone that they sell. Is that what you mean, Rita? And you have basically an agreement. She may be typing, I'm not sure.
Okay. If that's the case, yes, then I think there would.
She says yes.
If she says yes, okay. I think there's definitely, it's often a cost-effective way to reach new clients. But it's something, I think, one-off, you'd have to run the numbers beforehand. And I would want some sort of, I'd want information from these particular marketers of who can they reach, what is their reach, what's their following, that sort of thing. I'd want to really nail down and the people they say or promise they're going to reach for you, are they actually your target client? So I think it's a good idea, but you'd really have to look at those, you'd have to run the numbers beforehand, and I'd want to do some pretty thorough research before I'd agree to work with them or set up some sort of thing. I have had one client who's used those, and they did it as just a quick campaign, so they didn't sign a very long-term contract, almost as like not a probation period, but it was like a trial run for their business, and they ended up seeing value, but it was a good way, and the marketer offered a little bit, talking about expensive customer products, high tech, acting as.
So Rita, are you speaking as someone who is being an affiliate marketer, or is looking to gather affiliate marketers for your product or service?
Consumer.
Because I'm wondering if she's actually is doing the affiliate marketing on behalf of companies.
She's mentioned manufacturer's agent. Maybe Michelle, you deal directly with manufacturers much more than I do on my desk. Perhaps you've seen this.
So is it more like a distributor type arrangement? Is that
Rita, if you want to take yourself off mute, that might be, I'm gonna make sure. If you want to unmute yourself, that might help. It's up to you. Oh, there she is.
Okay, hi.
Hi.
I was trying to correct you that I didn't say customer products, I said consumer products.
Okay.
So they're high-tech consumer products. Say, imagine $10,000 item. And I've met the manufacturers and they're not very able to communicate their technology very well. So what I want to do is pair up with them to bring people through my site, explain to them in a virtual reality and some in sort of immersive ways, interactive ways, how they can use the consumer products that are available at $10,000, so that they can decide if they're going to put it on their credit card or they're going to make some payment arrangement with the manufacturer. But,
so in that case, you are the affiliate marketer then?
Yes, I am.
Okay. So, I mean, I'll just jump in terms of best practices as well. And Michelle, you can let me know, but there's a lot of companies, a lot of big companies that already have, you know, best practices in terms of what the percentage is that affiliate marketer gets. And I would just look at market rate. So if you are, you know, suggesting yourself to be an affiliate marketer on behalf of that company, take a look at some of the other biggest, you know, even similar in that industry, and look at what their rates are, because those aren't usually secret. So if you can say, you know, if it's comparable to some of the other, you know, companies that are doing the same thing, then I think that it's an easier sell than just coming up with a number on your own. I'd look at market value, but Michelle and Laura, maybe you want to let us know.
Would you have any suggestions of companies that actually do have these kind of relationships?
Yeah, so I'm thinking of anyone like, QuickBooks, for instance. I have a lot of friends that, you know, in their businesses, they promote QuickBooks or is it FreshBooks? Sorry, the banking people know better. QuickBooks does it, FreshBooks does it. ConvertKit, like I say, is an online tool that people promote. Gosh, there's just thousands of them out there. If you even just type like Google affiliate marketing opportunities, you'll see a whole bunch of companies that come up, and just, I would focus on the ones that would relate to your industry maybe and see what some of those percentages are. I imagine they'd be very similar.
Okay, great. Thank you.
Back to you, Laura and Michelle. And I'm just looking that we have about 3 minutes left, but are we in Q&A mode now, or do you want to go ahead, Laura or Michelle?
Yeah, that's all for our presentation, Carrie.
Okay.
So if there's any other questions.
Great, so any other questions? Yeah, well, let's open it up. Any other questions? So Shanice has a question for you ladies. Is it necessary to have an accountant or financial advisor? There's a good question.
That's a great question. I'll take this one. So at the beginning stages of your business, you do want to have a financial, any type of advisor. You want to start developing a relationship with your banker early on so they can help you grow. They might not be able to help you at the very beginning stages of your business, but they still have valuable advice that they can give you. And maybe at the beginning, you do want an accountant because, again, they've got great advice, but if you're just starting out, you don't really have sales yet, maybe just start looking at a bookkeeper just to help you with that financial aspect. But I highly suggest having an accountant or some sort of financial advisor. Laura, what do you think?
Yeah, I would agree. Maybe it is a bookkeeper, or maybe it is. I think the relationship there is really key. Bankers are your friends, not foes. And same with the accountants. At the end of the day, they can help with the planning. So, and provide any type of advice to get you where you want to be in the next stage. But I think the relationship part there is key, because ultimately, Shanice, you want to deal with somebody that you trust and value their advice. And at the beginning stages of your business, it's good to start, shop around, find somebody who gels well with you and you guys work well together. So I think having at least one of them at the beginning stages, to Michelle's point, I don't think maybe not necessary at the very beginning, but maybe a bookkeeper. At least one of them to be able to run ideas off of. They might have other connections too that can help you out. You never know. So.
advice. All right, we have time for one final question. If there's another one on the floor. Just shout it out or else put it in the chat. I'm trying to monitor if anyone's actually, sometimes people like put their hand up on Zoom and unless I'm looking at you, I can't see it. All right.
Can I ask if in these loans that are available through BDC and EDC and the government, is there anything that can change in the terms of repayment? Like they're saying the end of 22 is the earliest you'll be starting to get charged interest.
No, as far as I'm aware, whatever's indicated in the terms and conditions of the loans, they will be applicable for the life of the loan. It's possible in a couple months the terms might change, but if you've already signed up for the loan, it won't change within the loan itself.
I think, Rita, though, when you quoted the one that it's repayable 2022 for the CEBA loan or the Canadian Emergency Business Account one, I don't foresee that changing. That's a government regulated one, so I wouldn't be able to comment. I doubt that would change. For the EDC and BDC co-lending loans that are joint with institutions, they do offer up to 6 months delay. So if you advanced it, in certain cases, you can defer payments for the first 6 months. That's at least for EDC. For those loans though, you wouldn't see rates change. Everything I've heard and the ones that I've worked on, the rate is pretty well fixed for the duration.
Great. Well, I do want to thank you both, Michelle and Lauren. I'm sure there's lots of other questions that have started to percolate as a result of this. I always go into workshops thinking if I leave with one new thing or one thing that I can implement, like there's no way that everyone could implement everything. But if you took away one thing today and start working on that one thing, especially if you're starting out in business, there are various levels here that are represented in the group, then I'd encourage you to do that. And don't get discouraged if you haven't grasped it all. We've heard some great tips here today in terms of, get someone on your team that knows something about the numbers if that's not your strong suit. And if you're wondering, and again, if you're in the Kingston area, just connect with us at We Can, and we can perhaps connect you with someone if you don't even know where to start. So I think we've heard today that cash is queen. I'll say that because we're a women entrepreneurs group. Cash is queen and we can't ignore that. So good luck to you all as you continue to pivot and prosper as we move through COVID. Keep in touch, and I dropped my email into the chat if you'd like a recording of today, or if you just have suggestions even for future workshops. Just want to keep in touch. So thank you so much, Laura and Michelle. And to everyone, I hope you enjoy the sun out there. Have a wonderful Canada Day tomorrow if you're a Canadian. And for you Americans, I saw there's a couple Americans on today. Happy 4th of July in a couple of days. So have a great day, everyone.
Thank you so much, Carrie.
Thank you so much, everyone.
Thanks.